Carol, for forwarding these on. And I think we can probably, I don't know if everyone's had a chance to read through these. There's a tremendous amount of data, but if we just kind of start right here, this gets to the kind of the heart of the matter, if you will. And this is that for purposes of this report, the assumed rate of return was lowered from 6.75 to 6.5%, which is consistent with what was discussed last year. The amortization schedule was also extended to 20 years. So there were 17 years left on the fire. So it really didn't have a significant impact. That was a much more significant change for the town and police pension. Well, basically, the idea behind, if anyone's not familiar with how pension amortization works, the best way to think of it is not unlike a mortgage on your home. And that is, you have this unfunded liability, and it as well as normal costs that accrue, and it's how long you intend to take to essentially pay that down. And so, because of the length of the liabilities in the pension plans, it's not unreasonable to extend that amortization period out a bit, and so that's what was done. So basically, what's happened here is that reducing the expected rate of return has increased the present value of the liabilities. The reason is simply, if you anticipate earning 6.5%. It's going to take you a longer time to achieve your goals than if you are compounding at 6.75%. However, that was offset with the change in the amortization schedule, which was essentially extended the length of the mortgage, if you will, and so that has kind of an offsetting effect. And you can see the net impact is that the unfunded accrued liability increased by just over $47,000 because of the low rate. However, because of the lengthening of the amortization period, that actually caused the actuarially determined contribution, or ADEC, to decrease by $5,000.
Michael, has the actuary made any recommendation to us regarding the actuarial rate of return going forward?
No, there's no comments in here on that. I mean, I will say that the ongoing trend is to continue to reduce the assumed rate of return. Hooker and Holcomb, which is another actuarial firm that does a lot of work with Connecticut municipalities, every year does a survey of what are called CAFRs, or Consolidated Annual Financial Reports. And long story short, that discount rate has continued to trend down year over year. For 2019, which is the last year for which there was data, the average in the state of Connecticut was 6.74. So you're right there. You've actually, for the fire, come down a little bit beneath that, and it's consistent with the return expectations for the underlying portfolio. So at this point, there isn't a recommendation to change that, but that's something we're going to need to continue to monitor. And if you just kind of think through it, why is that? And if you just focus in on kind of let's set the equities or the risk assets aside for a moment or two, and think just to the fixed income assets. Pre-pandemic, we were talking about and starting to see interest rates creep up a little bit, and then we were up to the 1.5% to 2% range for the 10-year Treasury. At the height of COVID, we got down to I think somewhere around 35 or 40 basis points for a 10-year Treasury. And that's started to move back up, where I think we're at about 110 or 115 or so today. But, if you have 40% of your portfolio that has an expected rate of return of, let's say 1 to 1.25% for the Treasury, add on maybe another 100 or 150 basis points for the added return from using corporate bonds. And you're still looking at a long-term expected rate of return, probably somewhere in the low threes for your fixed income. So, if that's 40% of the portfolio, then the equities need to work all that much harder to make up the difference. And so, because of that, that's really the primary driver to continuing to move the assumption downward. But right now, you're really, slightly lower than a lot of your peers, or at least than your average peer, should I say. And it is consistent with the expectations and the asset allocation that are utilized by the plan. Now, there is one potential wrinkle to this, and I'm going to go all the way back to the end here. And if we look at, bear with me a moment, here's the page. Now you can see here's the 6.5%. A 2.75% rate of inflation is reasonably conservative in that we haven't seen inflation rates, kind of near that for some time. Certainly not persisting at that rate. Our capital market assumptions actually use 2.1. The Social Security is using 2.4 right now. So this is, with a slightly higher assumed rate of inflation, that's a bit more conservative. The other which will come up at some point is the mortality tables. You can see you're using 2010 mortality tables that were projected to the 2019 scale. About, I think it was a year ago or so, maybe 18 months or so ago, the Society of Actuaries started calculating separate mortality tables for municipal employees. And actually they even broke that out even more and did kind of public safety versus non-uniformed municipal employees. And that actually brought the kind of improved the mortality, which is great for the people that it's measuring, but it can add to the expense of the pension. And it was a little bit surprising. We kind of assumed teachers and the like probably were had a little bit better mortality than the general population. But one of the things that was a bit surprising about it is police and fire also had better mortality than the general population. So the municipal tables will tend to put a little added pressure on the funding ratio. So I suspect that's why Milliman didn't push for that in this valuation. However, because you made all these other changes, however, that will likely be a topic of discussion in coming periods.
Well, thank you, Michael. This is, I guess, a pretty dry discussion. The only juicy question I can come up with here is, what is the actual change, if any, in the cash contribution which the town is going to have to make to the plan in the coming year?
Yeah, it actually was, assuming you do what the ADEC or the actuarial determined contribution, it declines by about $5,000. In just a moment, let me look through the table of contents here to find the page here. It looks like page 17.
Page 20.
20? Okay.
Yeah.
Okay, so here we are. So for 2021, about $84,000. For 21-22, about $1,000.
Michael, could you go to page 20 where there's sort of a history of what it's been on the fire?
Okay.
There we go.
Yep.
What I noticed there is that the town contribution used to be just over $100,000 a year, and then 18, 19, 20, 19, 20 it went down, and I guess that would be because I mean, this is a fixed plan. I'm not even sure why there is any rate of inflation in there. I mean, it's been the same payouts for years and years and years. So as the payout is fixed and the investment values grow, the town has to pay in less. So as we're discussing the proposed fire plan, I mean, it seems to me that if the town thought that it could pay $100,000 a year for many years in the past, that perhaps getting back up to that level might be, or more, might be possible this year because, the assets are performing well.
Yeah, I think that's a great observation. I would just add, I'm sorry, did I interrupt you?
No.
No, okay. I think that's a great observation. The only additional information I would provide is remember, this is not a linear scale, if you will. It's not just, this was the performance last year, and so it immediately impacts the contribution. There's this concept of smoothing, so you don't have to bear the full brunt of negative years kind of all at once, but that cuts both ways because you also don't realize the positive years all at once. The idea is that smooths out the contributions over time, but as the plan becomes, better funded, then, it won't impact the normal contributions, but it'll tend to impact that unpaid portion of the mortgage, if you will, that we were talking about. But, as far as contributing more than the actuarial determined contribution, that obviously is more of an internal discussion for you all. But as a general rule, we're never opposed to contributing more than what the actuary recommends, because again, not to kind of belay the analogy, but it's like making an additional principal payment on your home mortgage every month. It'll ultimately reduce the amount of time required to amortize that. But I would, balance that with this is a long-term liability, and you actually just increase the amortization period slightly. So that would be kind of a step in the opposite direction. But in my opinion, there's rarely anything wrong with a little financial conservatism in overfunding if it's in the budget.
Well, my feeling was that it would have to be the contribution would go up because the benefits would have gone up.
Yeah.
Any other questions on this particular actuarial report? Oh, Michael, can we move to the next one, or is there anything else you needed to highlight for us?
No, I just wanted to, I thought, one thing that folks always are always curious about is the funded ratio. And you can see, and I think, to Paul's point, this is part of the reason why we've seen the contribution come down, because we've seen this funded ratio increasing. So with that,
so that's a good thing.
Yes, that's all things equal. That's a good thing. Yes. Next, we have the police plan, and basically look at the same, very similar observations, slightly different assumptions. Here we have gone from a 7% to 6.75. The fire plan, has always been managed a little more conservatively, owing to some of the unique nature of that plan. The 6.75, as we discussed, you are spot on with your peers. That's probably going to tend to continue to go down. As I mentioned, the average around Connecticut is actually 6.74. Now, there are a couple of outliers in that there's, although actually there are no municipalities in Connecticut that are continuing to use 8% or more. There was one kind of holdout until about a year and a half or so ago. And then there's one or two that, basically have fully funded plans that have very low assumed rates of return. But You're right in there with the with your peers. Now, that, as I mentioned, that'll probably continue to trend down. So it wouldn't surprise me if, if we look at this next time, the average is more at the 6.7 or even 6.65. But as it stands today, you're really consistent with with a lot of your peers. The amortization period, we can see extended from 12 years to 20 years. One thing that that we are seeing some municipalities do is what's called layered amortization, and basically rather than having kind of a fixed period, you're kind of doing a partial layering, if you will, because you're at 20 years until you get down to 10, and then it kind of remains at 10. But these are all different levers, if you will, that you can pull to adjust the funding requirements. And so what's been done here is we've reduced the assumed rate of return to make it more consistent with expectations, while at the same time increasing the amortization period to reflect the longer duration of the liabilities. The net impact is that the unfunded accrued liability increased by $528,000, but the contribution decreased by just under $156,000. So in other words, that lengthening of the amortization period more than offset the decrease in the expected rate of return. And you can see kind of magnitudes. We went from 17 to 20 on the fire plan. We went from 12 to 20 on the police plan. And so it has a larger dollar impact.
Michael, whose decision is it to extend the amortization period? Who makes that decision?
The decision is ultimately by whomever is authorized to do so at the town. I'm not sure if it's this body or who actually gives the instructions to Milliman, but that would be something much like the assumed rate of return. That's instructions that come from the town. Now, ultimately, the first couple pages of the report, which we didn't go over, but that's the certification, and that's essentially Milliman saying that all of the material in here passes the sniff test, so to speak. So in other words, if you had said we want a 9% assumed rate of return amortized over 40 years. Milliman's not going to, I can't speak for them, but I'm confident that they're not going to sign off on that, especially since you can't amortize for more than 20 years. But ultimately, that's a decision that you make. Your actuary has to validate it, if you will, because they're signing off on the reasonableness of it. But the end decision comes.
Joe?
Yeah, Michael, early on you mentioned the mortality. The data showed that the uniform services mortality was higher than what you expected. My question is, how about on disability pensions? Do you have any data that says uniform services are more likely to get a disability pension than the teachers or the town employees? Or do you know anything about that?
That's a great question. I don't know the answer to it. That's I haven't heard that discussed, although that does that sounds like it makes a lot of sense for the same reasons that we were surprised that the life expectancy is longer for uniformed service. I'd have to honestly check on that with the actuary and see, because they're much more familiar with the nuts and bolts of the tables. But I can certainly ask that question and follow up.
Okay, thank you. Yeah.
Sure. Okay. So moving on, and I'm just going to scroll rather quickly here. Let's see. Oh, I apologize, I lost that page here. Let me just go back to the table of contents. I'm sorry. I thought these were the same as they were all the same. Okay, so here you can see the projected contributions for 2021 and 21-22. So it's 755,000 versus a little under 627,000. And we can see the components of it. You have member contributions, normal cost, which is just, assuming you were 100% funded, this would still be the cost of maintaining the plan. And then past service is basically that amortization portion. And then brings us to the assumed rate of return. You can see as a percentage payroll, that's trending down as well, as you would imagine, for the because of the lower contribution, and payroll will tend to go up over time. Just scroll back a moment. I just want to find the funded ratio for you. And here we can see the historic funded ratio, this one moving, kind of in the opposite direction, a closed plan being, being paid down. So it'll be a little more volatile as far as funded ratio, since you don't have new folks coming into the plan. And of course, we've trended the assumed rate of return down over time. Although we've met the assumed rate of return and actually in most cases exceeded it, the funded ratio is still having some pressure because we have other factors working against it. So even though the value of assets has increased, and of course you're making benefit payments, but the accrued liability continues to grow as well.
Yeah.
Any other questions for Michael on the police actuarial report? I guess we'll move on.
Okay. All right. And so moving on to the town employees, we're going to see a similar assumptions that were used for the police plan. We went from 7% down to 6.75 and extended the amortization period. Again, this was 17 years going to 20, so this is going to have a lesser impact than on the police, where we extended the amortization period for a longer time period. And you can see that about an $800,000 increase to liabilities from the reduction in the assumed rate of return, and about an $11,000 decrease in the ADEC, coming primarily from the extension of the amortization period, offsetting that and a little bit more. Okay, so moving on to the other data that we had looked at, and all this stuff that I'm going through real quickly, just kind of, I'll leave to your leisure reading, but it just kind of slices and dices the population, how long they've how many years of service they have, how many folks are active, how many folks are retired, disabled, etc.
There are 2 people that are under 25, so we're going to be doing this for a long time.
Long time. Yes. That's the, I make the same analogy to defined benefit pensions as I do to internal combustion engines. And that is, their peak years may be behind them, but they're going to outlive all of us. And but you see the funded ratio here, at 65%. And here's your contribution. As we discussed, not a significant impact. But moving forward here, I just want to find this historical funded ratio if I can. So let's bear with me 1 second, please. Okay, so here's your projected contributions, again, broken down as to the different components of them. Normal cost, again, is what it costs to, sort of maintain the pension, if you will. Then you have, minor contributions in this plan, expected expenses. And then again, this past service cost is basically amortizing the unfunded liability.
So one question I have, and this kind of goes back to, I think, Jeremy's question about the contracts, because I can't remember. Do the contracts call for an increase each year pegged to inflation or cost of living, a COLA?
I don't, honestly, let me check and see if there's a
I
COLA.
don't
Maybe
think so.
The police pension does have a COLA
COLA,
increase
okay.
each year. But that's the only one.
Okay, so that's kind of important in looking at this, because if there is a COLA, then if we do get inflation, that's going to increase our cost, but we could also expect the Fed to probably make some moves to raise interest rates, which would help on the fixed income component of the portfolio. So it should offset, but it's interesting.
Yeah, that's exactly right. I mean, it's the inflation conversation is kind of rearing its head again. The Fed really hasn't been able to stoke any sort of inflation for going on a decade and a half, and it's still an open question whether the tremendous amount of stimulus out there will ultimately stoke inflation. We're certainly seeing some commodity price inflation. Whether or not that gets to kind of historic levels, because remember, we're coming off of very low levels. But certainly that's something that we're going to continue to keep an eye on. But Jim, that's a good it's a good point, and that is that we're also looking at the potential return on fixed income in a good broad tool or blunt instrument, if you will, as to your expected rate of return for fixed income is the 10-year yield plus some additional return for the incorporation of spread product or corporate bonds into the portfolio. But absolutely, if we get significant inflation, that causes the Fed to have to be very aggressive, then that can certainly impact asset prices, while at the same time the COLA will continue to see the effect of that.
The other inflation effect that you get is as people retire and start drawing on the plan, they're drawing at an increasingly higher rate because their last 5 years of service, there's been raises and adjustments. So.
Mm-hmm. Yeah, I mean, that is factored into the actuaries calculations. They use the underlying provisions of the plan, but absolutely, in terms of absolute dollars, there's all these kind of almost some of them are almost morbid in a lot of ways, but it's sort of what's best for the pension plan and what's best for the pension recipients are typically opposite, right? Someone, unfortunately, if one of the things we've seen over the past couple of years and are probably going to continue to see is we've seen life expectancy, at least in the near term, seems to have sort of peaked. And a lot of that, at least the best estimates I've seen, is that, that comes from a combination of just sort of a normal plateau because we've seen such an improvement, but add to that, the opioid crisis is weighing on life expectancies a bit, and we'll probably see, or not probably, we will see in the next year or so what impact COVID has had, because that, of course, has disproportionately impacted the mortality of people that are of the age to be pensioners.
And there's the beneficiary component, which can continue.
Yep.
Al, I have one comment and one question, if I may.
Fire away.
Okay. The comment, picking up on somebody said something a minute ago about the last 5 years of your salary is going up. As I recall, in the town plan, it's not based on your 5 years. It's you get a little smidge through of, I think it's 1 3/4% or something such of all of your
All your earnings, right?
yeah, all your earnings. So it's not based like the state or somebody. It's not based on your last 5 years. Then the question I have, Mike, if you could maybe go to on the for the town, I think it's on page 8, which has the a chart of the members. I think it's 8.
This?
No, back up to, that's 10. Back up a couple.
Oh, I'm sorry, 8 on the PDF. Okay, got it.
Yeah, what, okay, there, right there. Okay, my question is, how come the number of members, the total members have been going up when this plan was frozen, you know, back in 13 or 14 or someplace?
That is an interesting question. Honestly, I'd have to check with the actuary on that. Let's see.
I mean, and I can see where the members in pay status will go up as people
Yeah.
retire and move off active roles. And, but the active members themselves have gone up. And of course, this chart doesn't go back to the 13 or 14, whatever. But
It looks like they
total-
only went up. Was there a change in 16 to 17? Because that's the only year where it's really gone up. At least the active members. Were some folks, you know, grandfathered in or something? It looks like something unique may have happened in 16 to 17.
Well, I think that's what I'm getting at. I seem to recall maybe, I guess I just want it on the record that I think it was the Board of Ed ignored the closeout from, even though they were part of the discussion decision, they ignored the decision and kept adding people for several more years. So I guess I just wanted that bit on the record.
Okay,
It's a little upsetting.
sure.
Al, do you remember that?
I do, Fillmore, and perhaps that's extraneous to what we're doing this morning, but
Yeah.
I think you may be right. The only other explanation I could come up with is perhaps more people became vested at a certain point in time and entered this pool.
Oh, there's a thought.
It's certainly something we can get to the bottom of. We'll have to work with Milliman on that, but as to exactly where those 12 people came from, but that's both of those sound like they're plausible explanations.
Michael, is there anything else in any of these actuarial reports that you need to bring to our attention? Anything in which we're
No, if
out
you
of
just-
line with our compatriots?
Just to kind of keep it consistent, I'll show the let's find the expected contribution, which is right here. And again, similar to what we looked at before, but you have your normal cost and then the past service cost, as well as minor contributions and expenses, and then the actuarial determined contribution. So I think the overall theme for all three of these is the same. You're moving, kind of consistent with the market and consistent with industry trends as far as the assumed rate of return. Lengthening the amortization period is a tool that can be used to kind of soften the blow, if you will, on the contribution side. But it is also, quite frankly, consistent with the underlying duration of the liabilities. To Paul's point, there are these plans, even though they're not actively adding members, there's a very, very long tail on these, and they'll be around for a long time period. So extending that amortization period is, to our way of thinking, is reasonable.
Any final questions?
Yes, Al, I have another question for Mike before I know he has to depart. And this is sort of a long view question. Let me start by saying that the town's fund balance is in a healthy position right now. Let us suppose, and now this is something for you to think about too.
Yeah.
In your board, let us suppose that we decided that it would be a good idea to place X dollars, just an extra special appropriation from our fund balance into one or all three of the town pension funds. The rationale being, well, several rationales. One of them being is that the money right now is sitting, earning maybe a 0.5% or something in a bank, but we could get 6 3/4%, at least on paper, and it would also serve to lower the required contributions in the future, and thus make it easier on the taxpayers. If we were to get this done and get it into your hands or whoever's hands by June 30th, in other words, if we got it done in May or early June or whatever, would that have an impact on? Would that be in enough time to have an impact on next year's ARCs?
The ARC, I believe, is calculated as of the value on fiscal year end, which for these plans is June 30th. So yeah. I think the short answer is yes.
Okay.
The devil's in the details, of course, and it would depend on the size of the contribution and what kind of the overall intent is. Intent's not really the right word, but let's just say, for the sake of argument, we're dealing with this with another shoreline town right now who basically took some money and is fully funded their OPEB, but they are amortizing those contributions, if you will. The money's in the OPEB plan, but it's being amortized. It's actually being invested over a period of years, consistent with the underlying liabilities, so that to take out some of that market timing risk, if you will. So let's just say, for the sake of argument, you made a contribution that's equal to 20% of the value of the pension. But you don't want to just, kind of hope that June 30th is the best time to invest that. And we spread it out over a year or two or what have you, that 0.5% return on cash that you alluded to will be a drag on that initially. Whether or not that matters to Milliman, we'd have to have that discussion with them. But those are the types of things that we should think of. But all things being equal, yes, it's always good to have the plan as well funded as you can. And I would also add one other ancillary potential benefit that wasn't mentioned, and that is that from in your conversations with the rating agencies, of course, that's a well-funded plan is also a plus to and that has the potential to reduce some of the cost to taxpayers down the road as well.
So if we could bump up that 65% or the 69% by a few points, that would look good. Yeah.
Yep.
Okay.
It's all, it's one of those things, I think, from the rating agency's perspective, it's not so much about the absolute number, it's about the direction of travel. Because, no one's glasses are rose-colored enough to assume that, municipalities can just, write a check for half the value of the pension to fund it up. But it's all about direction of travel.
Okay. Thank you.
Good. Any final questions on the actuarial report? If not, Michael, let me ask you to swing right over to the performance reports.
Okay, great. And
And
thank
is
you
Claire
all
gonna
again
jo-
for being considerate of my time restrictions this morning. So Claire is with us, and Claire will run through the performance reports briefly, and then we will look at rebalancing. And if there's any time left, we have a few other items on the agenda, or if not, we had talked that they may get tabled to next meeting. So we have the fire plan is first in the book. Is that okay if we start with this?
Certainly.
Okay. So Claire, take it away.
Okay, unmute. Michael, can you maximize the page
Oh, sure.
so we're not squinting too much? Okay, thank you very much. Okay, super. So I'll keep this pretty short. On the whole, we've got good news, and that always makes things much easier. Obviously 2020 was a crazy year. We started off on a huge negative, and then the markets took off running and really never stopped. But there was definitely, as we talked last quarter, there was parts of the economy or parts of the market which fared very well, and others which were struggling terribly and are still having a hard time keeping their heads above the water. So where you were invested definitely had a huge impact. And just sort of as a summary for the year, there was a massive spread between, the technology sector was up over 40%, the energy sector was down a negative 30%, and then sort of in between there was a whole swath. For the year, finance, real estate, and energy were all in negative. We saw a big rotation in the fourth quarter in that, with the vaccine, that obviously made a huge impact to the survival for companies as well as for people. So, we did see a surge in the energy sector, the financial sector, industrial sector. So obviously that is a huge difference. And I guess in summary, don't fight the Fed. The Fed's pumping billions of dollars, and that's what's kept the markets in the strong positive returns. So first of all, let's look at the plan, and we'll sort of step back and take a long-term view. And so we're looking at our returns going back to inception. So we're starting back sort of early in 2014, and our annualized return, we're up just a wee bit short of 7.3%. So, we've got, using a word from earlier, a smidge of outperformance. Our tailored benchmark was up at 6.9%, so a wee bit ahead. Our beta, that's the volatility. Our benchmark is at 1%. We're just a little bit under at 0.99. So if we look at the upside and downside deviation, so when we're in positive territory, obviously we'd like to be ahead, but so we're keeping up pretty well. We're capturing most of that upside, 5.66 versus 571. But on the downswings, obviously we don't want to capture that. It's much harder to make up for losses. And so we do have a bright, so a slightly wider swath here at 7.5 versus just under 7.8. And that all comes together in the alpha. And the alpha says for the risk of volatility in achieving our long-term return, there's an expectation of what that return should be. And at a 0.04, obviously it's a pretty small number, but alphas do tend to be, but we're on the right side of the tracks here. So our return was ahead of expectations, and overall the investments have added value. So what does that mean in terms of the dollars? So we started with $0 back in 2014. And as we mention each quarter, you're going to ignore those contributions and withdrawals because they're the same as purchases and sales. So every time there's cash flow or rebalancing of the portfolio, bulks both those numbers up. So we focus instead on the net cash flow. So just over $1 million went into the fireman's benefit plan since 2014. And then we also saw growth from realized and unrealized gains, plus interest and income to the tune of just under $706,000. So we closed the year with $1.7 million. And then just to give you an update through yesterday, for 2021, there was net withdrawals of 12.6 thousand, so pretty small number. But the portfolio did gain $69,000. And so as of yesterday, the value was $1,791,431. So that's an increase of about 4%. So that's good news. We're sort of continuing those gains from last year. So for that short time frame, just about 6 weeks, up 4%. Whether we'll keep that going for the rest of the year, as Michael said, the fixed income market is going to be pretty lean, and so we'll see how the equity markets continue to do. So looking back at our individual portfolios, back on page 2, our allocation here we have at the end of the year, so we're now stepping back, we have 62% in equities, 36% in fixed income. So looking at the numbers, on the whole, we have, terrific numbers. A little bit shy on the fourth quarter. A couple of portfolios took a breather, but especially when you look at the fiscal year, that the last 2 quarters, when the markets were going gangbusters, there's pretty impressive returns on that fiscal year column. But for the year, the numbers are terrific. 12.2% versus 10.6. It really was a super year. So we'll capture all that outperformance and it'll be put to good use. And that outperformance continues on the 3 and 5 year timeframes. In 5 years, we're up 8.7 versus 8.4. And it's sort of under, it's great. Sometimes it's better to be lucky than good. Some of the tactical allocations that were put in place, certainly did sort of pay out very nicely. Back in the first quarter, when we took the overweight to the fixed income, when we had the equity markets dropping noticeably, sort of holding that cash back and feeding it in when the markets were cheap, and then we rotated into that overweight in to the growth sector of the market. And as I mentioned, that was the best part of the market for most of last year. So for that about 6 month time frame, we captured that 30% from the large growth part of the market, which obviously was very beneficial. And Michael's going to talk about making a change back to the strategic long-term weight. So we that worked out very nicely. And obviously we're indexing a large portion here on active territory. We have Transamerica and Lazard for our international portfolio. Transamerica is more value oriented. Lazard is more growth or blend. Transamerica took a bit of a breather in the fourth quarter, but ahead for the year. In fact, their return was 6.8% with the EFI value index in negative territory for the year. And so pretty much it was the same internationally. There was a really wide spread between value and growth domestically and internationally. Lazard, they're outperforming across all time frames. They actually took advantage of the value side of the market sort of had been noticeably oversold for some time or ignored, if you like. And they actually sort of at the beginning of the year started buying up some companies that they saw had been sort of hung out to dry. And the first couple of quarters, it took a while for that to sort of to prove its worth. But, in the fourth quarter, they outperformed, and some of those companies they picked up did very nicely. And so for the year, they were up, 10.7%. It was a good year. Invesco, Oppenheimer, developing markets. Longer term, they've done fine. For the year, they fell short a wee bit just because they tend to think of South Korea and Taiwan as developed markets, and they're underweight there. They also don't have a position in Samsung. And obviously, everyone was out buying new televisions when they were all stuck at home. And so Samsung was a very strong performer. So that shortfall did cost them. And then moving on to real estate, obviously it had a tough start to the year, but Cohen and Steers, I think this is the benefit of having an active manager. They navigated the market incredibly well. And there are parts of the real estate market that have done very strongly, and they've tended to be overweight in the data centers, self-storage, towers. So that sort of played well for them. Onto fixed income. Blackrock is our high yield, and we can see looking longer term the benefit of having the high yield in the portfolio. And Blackrock, they fell short a bit for the year. They started off pretty aggressive in the first quarter, had an overweight to the junkier, triple C area, and that hurt them in the first quarter. So then they sort of pivoted back, took a more defensive stance, and then of course the market, was very strong, and so that hurt them. Long term, they do a solid job. So we think that high yield portfolio does add value. And then for Voya, they're falling slightly shorter term. They had an overweight to corporates, which was beneficial, but it was sort of within the investment grade portfolio, which is pretty focused, that higher quality tilt did hurt them because, as with the equity market, the sort of more volatile, lower quality companies did well. So they fell short just a little bit for the year, but on the whole, a solid position there.
Okay, so just give me a moment if I can.
And it's pretty much the same story as we move.
Yeah, I'm just looking. I
portfolios.
wanted to show the rebalancing sheet. Just give me a moment to
Okay.
navigate, please. And here we are. Wow. So I'm going to blow this up because we don't need to focus in on all, and I really want to focus in on the pie charts at the bottom. As Claire mentioned, we've had about a 4% increase in the value of the plan since the end of the year. As of February 16th, $1.791 million. And you can see target allocation at 60% in equities and current allocation at 63.8% in equities. Just to refresh everyone's memory, we typically recommend rebalancing when you're at a 5% variance from your stock to bond allocation. So we're not at a level where we would, be kind of pounding the table to rebalance. However, you're starting to creep up on it, and if the market continues to move in a positive direction for the next several months, it's certainly not out of the realm of possibility that we can be outside of that corridor by the next time we meet. In addition to that, you are a little bit low on cash, so we'll need to raise some cash at some point. So you wanted to open it to discussion a little bit. I think in general, everything we've discussed today is that the equity markets are continuing to show some strength. We're starting to see interest rates cycle up a little bit. We don't anticipate them really spiking, but at the end of the day, longer term rates may start to move up. The Fed is certainly going to keep short term rates low, but I wanted to kind of open it for discussion in that we wouldn't necessarily recommend a rebalance at this point. However, it is you're coming up on that, and so kind of one of the thoughts that we had is maybe to keep some of the overweight to equities, but basically raise cash. So we wouldn't necessarily add to the fixed income. We just sell proportionately from the equities to basically raise the $33,000 to replenish the cash. And so that would be kind of a way to make sure that we have the cash needs addressed, but still allowing the equities to have a little bit of an overweight during a time period when they're outperforming.
Makes sense to me.
Which of the holdings would you, or would it be proportional across all of the equity?
Yeah, it would be proportional across the equities. Now, for for practical purposes, I'd have to do the math out, but I suspect, this one that's selling $2,300, we would, we'd actually wind up needing to sell less of that. So some of those smaller trades, we'd probably just eliminate and bunch together. But, essentially we would proportionately take from the overweight areas, which are those in the cell or the red in this column.
I should have looked at that column. I would have answered my own question.
I put my little arrow on it for you, Jim, but you can't see it. So
Thank you, Paul.
Yeah. So I'd feel comfortable, phrasing that as a recommendation to the board that we proportionately rebalance to raise cash, But other than, other than cash raised from the overweighted allocations, we'd forego a portfolio-wide rebalance at this point.
Michael, do we need to take a formal action on this?
I think historically you have. That's really a governance question for the board. However, it's, as far as I'm concerned, it's, if you give me the okay, I'm good. But I think historically that has been voted on by this group.
I'll make a motion that we rebalance according to Michael's recommendation.
Thank you, John.
Second.
I see a second. Do we need any more discussion on this? Don't see anybody. If not, let's vote on this motion. All in favor of doing the rebalancing as Michael has recommended, please say aye or raise your hand.
Aye.
Thank
Aye.
you. Anybody opposed, thinking this is a bad idea? Any abstentions? I don't see any, so the motion carries. Michael, please carry out some rebalancing.
Okay. Okay, so that's the wrong spot.
Which tab?
All right. Thought I had gotten rid of all of those. I apologize. Okay, so I need to. Bear with me while I. What happened? There it is. Okay. All right. So next we move on to the employee plan.
No, so police next. Okay, hang on. Turn to employees. Okay, super. Thanks, Michael. Okay, similar numbers we're looking at here, except obviously we've got a much longer time frame. We're going back to October of 2006, so we've got a good number of years under our belt. Our annualized return, we got a little bit more outperformance here. We have a return of 6.8%, or just over 6.8% versus just under 6.5%. With our beta, noticeably less risk here, beta of 0.93, so 7% less volatility in achieving that outperformance. And when we look at our upside and downside, again, capturing most of the upside at 5.9 versus 6.3, but a noticeable spread here. Obviously, we've got more numbers under our belt here, so it certainly becomes even more meaningful, but 8.6% on the downside versus 9.1%. So in those periods when the markets dropped, there was the preservation of capital, which obviously is a great thing as we look over the longer term. And that comes together with a larger alpha, 0.06. And you don't even normally see alphas over 1% are really rare. So that 0.06% actually is more noticeable. So value has been added over that long-term time position. Looking at our cash flows, we started with just over $10 million. Overall, our net withdrawal since inception has been just under $830,000. So we've seen noticeable growth here of just $15.2 million since that period of inception. So we closed the year at just under $24.5 million. So again, we're seeing the same sort of increase, just over 4% year to date. We did see net withdrawals through yesterday of 152,000. So we had a gain of $1 million year to date so far, with the valuation yesterday of 25,371,461. Okay, and then looking here, our allocation a bit more aggressive. 67% at the end of the year was in equities, with 31% in fixed income and 2% in cash. And the same story on the quarter, a little bit of a breather, although let's face it, a 10.4% return for a quarter is pretty darn impressive, but the markets were on a roll. So finished very strongly. For the year, again, we have that nice bit of outperformance, 13.3% versus 11.6%. And we also got a noticeable boost from having the allocation to the large growth. And if we, obviously that was a tactical shift of incepting that portfolio. And had we, just kept our benchmark the same, our outperformance would have been more noticeable, because, we got just for 6 months, a 30% return from that area. It really was a very strong part of the market. And again, so we see that outperformance continuing for the 3, 5, and 10 years. Your 10-year return is up 6.7, so just a wee bit ahead of our benchmark. So, really solid returns across the board. Looking down at our portfolios, the same lineup pretty much as we just looked at. One of the differences, the T. Rowe Price. They did take a breather in the fourth quarter, although again, they underperformed with a lowly 24.7%. I think I mentioned earlier, we did see that rotation into small caps. And, T. Rowe Price did a phenomenal job for the year. Even with that underperformance in the fourth quarter, they were up over 25%. So, over a 5% spread for the year. Part of the fourth quarter, they were somewhat underweight in technology. Some of their selection in healthcare pulled them down, but overall it was a gangbuster year, and that outperformance is across the board. And then we saw all the other portfolio managers we talked about, the same managers in place that we looked at earlier.
Okay, so let me just bring up the rebalancing spreadsheet. Just give me a moment to find it. Okay. So similarly, similar to the fire plan in direction of travel, although higher equity allocation. So here we're at our target is 65% in equities, and we're overweight by about 3.7%. Again, all in all, we wouldn't necessarily recommend rebalancing. However, we do need to raise some cash for benefit payments. You can see we're at 1.15 versus a policy of 3%. So we'd make the same recommendation we made for the fire plan, and that is not to do a full rebalance, but to adjust these sales proportionately to raise the roughly $470,000 to shore up the cash, and then keep a slight overweight to equities.
All righty, that's a formal recommendation then, Michael?
Yes.
All righty. Any of our committee members want to take Michael up on his recommendation?
I'll make the motion that we do the rebalancing as recommended.
All righty, I see a second. Do we need any discussion on this?
The only question I have is how, with our cash position being at 1.15%, did that just have to do with the timing of the payouts?
That's exactly right, because benefit payments are made monthly, and so it's just it's a function of there is a kind of a drag on cash, so we've always had to periodically shore that up.
So, Michael, are you still feeling good about Fidelity large cap growth, which was, the big move we made during the, the reckoning back?
Yeah, I think in general, it's a great question. We are, as we know, we kind of pared back some of the overweight to large cap, but we are still definitely favoring growth. It's not on, I'll without kind of giving too much of a clue as to what's coming down the pike. We will at some point, start to normalize that a little bit. We already have to a certain extent, but growth is still, growth still has a lot of potential going forward in the market. Some of the stay-at-home names, the Zooms and the like, certainly are going to feel some pressure, but some of the other, the growth sector of the market in general is really continues to do well, and so we do like continuing to have some of that exposure, but that will in all likelihood evolve. I would anticipate over the coming quarters that we'll continue to pare that back a little bit. But if you look at that index, some of the biggest names in that index, and you all know them. Apple's the largest component, followed by I think Microsoft, I believe either Google or Amazon, and some of the growth names, while they had a tremendous run last year, we're seeing that follow through, and in some of the ones that relatively underperformed, Google or Alphabet, as it's now known, really have gotten a fair amount of wind at their back so far in 2021, and so I think some passive growth is still, and U.S. large growth is still a good spot to have a bit of overweight to.
We have a rebalancing motion in front of us. Does anybody have any comments? Let's vote on it. All in favor of following Michael's recommendation for rebalancing, please raise your hand, say aye.
Aye.
All righty. Anybody opposed? Motion carries. Thank you, Michael.
Okay. And now let's
We're on the home stretch.
in the home stretch, and let's see. And here we are for the police pension.
Okay, so a similar story that we have just run through. And we have a good bit of history under our belts. We're going back to the beginning of 2005, and our return since inception, just under 7.6% with our benchmark on 6.9%. Again, less volatility in achieving that return, about 4% less. Our beta is at 0.96. And again, we're capturing on the upside most of that positive return and providing downside protection when the markets have been in negative territory by a much more noticeable amount, 8.13 versus 874. And that comes together with our best alpha of 0.08%. So, for the volatility that was taken in achieving our long-term return, our result was nicely ahead of expectations. So hope, obviously our goal is to keep that growing and, make that an even better number as we move forward. Looking at our cash flow, we started with just under $8.8 million. Over the period since inception, we've taken out pretty much nearly all of that money. So our growth in the portfolio came from the investments, and that was to the tune of $15.3 million. So we closed the year at just under $16 million. I'm happy to say we jumped over that $16 million mark. There were withdrawals of just over 100,000, but we gained 680,000 year to date. So up about 4.3%. And so we closed yesterday with 16,528,056. So that's good to get over that.
And just a quick comment, if I may, and I've made this before, but I think it bears repeating. Very often there's this debate you see in the popular press about active versus passive and which one's better, and so much of it comes down to the person writing the article has a thesis, so they seek out the data that supports their thesis. But I think this really goes to show how a combination of active and passive long-term benefits, because just like we diversify our holdings, we diversify our active and passive exposure. And this little bit of excess performance, 6.9 for the policy versus 7.58 for the pension, may not sound like a whole heck of a lot, but when you look at it over time, you can see that that's added 32% in additional return, total return at 222% versus 190% for the policy. And, just a little back of the napkin math, another 32% on a beginning value of $8.7 million. And, you're looking at the better part of $3 million in excess return that's come over this time period, from a function of the asset allocation decisions, the active investment decisions, some of the tactical changes, et cetera. So this, I think it really just kind of drives home, why we do this. And if you look at it quarter to quarter, you can sometimes sort of scratch your head and say it's, it seems like an awful lot of effort for not a lot of reward. But the idea is not just how we perform at a point in time, but it's how we perform over time. And and I think it's really borne fruit here. So with that, let's move back to the.
So our allocation here, we closed the year 67% in equity. So you can see the direction where Michael's going to be going in a few minutes. 31% in fixed income and 2% in cash. And again, taking a wee bit of a breather in the fourth quarter, although still up 10.3%. But for the year, again, we see that nice bit of outperformance, 11.9% versus 10.5%. With that outperformance over the 3 and 5 years, and just a wee bit behind on the 10-year number, but as we noted, nicely ahead going back to inception. A couple of different managers in our lineup here. Davis Advisors, this is a concentrated portfolio. They have about 25 positions. So sometimes they live and die by their sword, and they have a noticeable overweight to the financial sector. About 41% of the portfolio is invested there. And a lot of their top 10 holdings, they have major conviction in, they're all about 7% in those holdings. Alphabet, which obviously was very beneficial, Amazon, very beneficial, Google, they're all 7% weights, but Berkshire Hathaway, Capital One were also 7% positions in the portfolio. So they had a finish on a very strong note, but look at their 1-year number. The value side definitely had a much tougher time of year, but they were up 12% versus 2.8. You can even just, looking at the spread here for the year, the value index was up 2.8, the S&P was at 18, and large growth was over 40%. We don't have it here, we don't have that number, but it was just a huge spread in returns that were available. Then BlackRock we added in, and we've got a short-term history. They came on board in September of 2019. But they just had a gangbuster year, up over 46% versus their benchmark, which was about 35.5. Ernest Partners, they took a breather. They're underweight in healthcare. That rallied strongly towards the end of the year, and biotech. They just thought there was a lot of overvalued companies, especially in that bio area. A couple of times they have underperformed, and it's not very often. It tends to have been because overheated biotech healthcare market. So they took a breather, but for the year we can see on both the portfolios, their small mid-cap portfolio and their small cap value portfolio, noticeable outperformance. They were up over 13%, and their SMID portfolio and up over 15% for the year on their small cap portfolio. So very strong returns from them. And then we see our usual suspects for the rest of the page. And then one difference we do have here on the next page, we have Invesco as our real estate portfolio. Long term, they've got solid returns. They did fall short last year, and they did underperform their benchmark. Part of it is, they focus on long-term growth, and they did okay in the first half of the year. They actually sort of matched and exceeded in the first 2 quarters. So this underperformance all came from the third and fourth quarters, where we saw, their portfolios just weren't set up for, the stress test of the third quarter of COVID, and then the vaccine and the surge in enthusiasm in the fourth quarter. They were sort of tending to look at higher quality, longer term growth. So they just sort of missed out on a lot of that, the bubble of enthusiasm. So, we appreciate that the 1-year number, it's solidly negative in what was a tough market. But long term, they have proven themselves. They'll do just fine. And as we're seeing, this year, I think will be still a little bit gnarly because we have the Fed pumping so much money into the economy. But as we look, to the longer term fundamentals, Invesco have held up consistently well historically, and we don't doubt that they'll continue to do a good job. Obviously, we'll keep an eye on them, but we'll be just fine. And then Michael will turn to our rebalance.
And so for the police plan, we've seen since the end of the year about $25,000 in contributions, $130,000 in withdrawals, and $680,000 in earnings. And moving on to the rebalancing, a similar theme and recommendation to what we've discussed with the other plans, and that is, we're overweight by about 3.75% to equities. However, we would be comfortable with that, but for the fact that we're underweight in cash. So our recommendation is to proportionately, adjust these sales to raise the $335,000, shore up the cash, and keep a slight overweight to equities. So we would respectfully request that for a decision today.
Could I have a motion, please? I see Joe. Second. I see
Second it.
Paul. Yep. All righty. We have a motion to rebalance as Michael has recommended. Any discussion on that motion? If not, please signal your approval by raising your hand. I see everybody on board. Any opposition? All righty, the motion carries. Thank you, Michael. We like your recommendation for rebalancing.
Great. Well, thank you all. It's a little after 9:30, so I am going to drop off. I have to bring my wife to the doctor, but thank you very much for accommodating my my schedule, and look forward to seeing everyone next quarter. And if anything comes up, or are there anything that you'd like to discuss that we cut short today, feel free to give us a call or send an email. We'll be happy to discuss offline as well.
Thank you, Michael and Claire. Thanks. I'm going to keep this committee in session for one more item.
Okay. Bye all. Thank you.
Bye,
Thank
everyone.
you.
Bye.
We're going to defer all of the items on our agenda number 4 till the next meeting. Michael assures me there's no urgency, so we'll pick those up on our next agenda. But there is one item that the Board of Selectmen has asked us to give them our opinion on, and that's our agenda item number 5, which is to have a look at the benefits currently offered under the fire benefits program. And let's see, I'm going to look to John Brady and Bill Carroll to walk us through what the 2 fire companies are proposing to town government for an adjustment in the benefit. The material Cheryl sent out in advance has this 1-paragraph description of their proposal, but I will ask them to go through it right now, the rationale and what they're actually proposing. I will be looking to the committee for not only a discussion, but whether or not we would like to motion this onward to the Board of Selectmen and Board of Finance. So,
Al, got a question.
Bill?
You're showing up twice and one is not your picture.
It's Carol.
I have a twin. Bill, I think, used my sign-on credentials today. The second Al Goldberg, along with John Brady, will carry the ball for the moment.
Well, the second Al Goldberg is a much better improvement than the first one. Now look at it.
Thank you, Fillmore. I appreciate that. John and Bill, why have you come forward with this?
Yeah.
Well, you want me to start, Bill, or?
Yes, please.
Okay, basically, what we've, we're hearing from our members is that the pension plan has been in effect for about 30 years now. I believe it was 1990. And there's never been any change in the benefit. When it was, I guess, developed, I'm not sure what the thinking was, but basically that $5,000 maximum per year benefit in real purchasing power today is probably worth about half of that. We've done some calculation based upon inflation at a 2% rate. That would have been the value of that today would be about 9,600. If we were at 2.5%, the value of that would be about 10,400. But basically what we're at, and we're asking that the town consider increasing the benefit to something that is more in tune with the value of that money in today's dollars. So, and our proposal is to increase the payout by $1,000 a year for a 5-year period. And then after that, an annual increase tied to the Social Security cost of living. So that's basically what the proposal is. And I think part of the justification is that the town is saving a significant amount of money by having an all-volunteer fire department. If we looked at the town of Guilford, they have nearly a $5 million a year budget for personnel and labor cost. So, you know, we know there's a little bit of a hit to the town, but we're all taxpayers too. And that's why we're trying to level it out and do it over time. And I think when Michael went through some of the numbers earlier, we saw that, you know, the town was paying at some points up to $115,000 a year to support the pension plan. And now we're down to less than $60,000 a year. So certainly, you know, it's not without precedent to raise that amount of money. So, Bill, I don't know if you want to add anything.
No, that's pretty much, you know, what we were looking for and trying to describe it best to the committees.
All righty, Fillmore.
Yeah, I just have some questions. For whatever reason, I don't have that document, so maybe it's in there and I just don't see it. Okay, suppose if we follow what I heard you say, that in 5 years that payout goes to 10 grand a year, and you certainly make a decent case for that. Does that apply retroactively so that the people who are now retired and getting the 5,000, you know,
they would get the increase? Our expectation is that those that are collecting would collect the new amount, Fillmore. Yes.
Okay, and then after 5 years, it goes up a smidge based on the inflation rate. So in 6 years, I'll grab a number here. Everybody will be getting 10,500 or 10,100, and then 10,000 next year after that.
Yes.
So it's basically an inflation-based pension.
Right. Basically determined by the Social Security increase. That would be the basis or the factor that would be used to calculate the annual increase.
What happens to the people who are not at the max? I mean, or is everybody at the max? I mean, there's at age 60, I see it's $250 a month when you're 20-year vested. What goes on there?
I think we could, you know, do that proportionally, Paul, because that 250 is roughly I don't know what the number would work out to be, but it's a, you know, we do it in a proportion equal to whatever that amount would be.
Joe?
Yeah, in the past, you had different requirements. Hose company number 1 and nomads were slightly different. Have you rectified that difference?
No, that's still there, Joe. And basically those, that would point to Paul's point that the increases would be proportional to what those numbers are.
Right.
They're both full vesting after 20 years, but because the host company has a 12-year requirement for basically a lifetime membership, and the North Madison Department has a different requirement. Those two things would remain the same.
So I see
another
there's
question. Obviously, this hopefully will be a good recruiting.
Oh, absolutely. And,
Yes.
you know, I think it's really served to keep people in the department longer too. And, you know, for those of you who are not aware, we just made a change, or the Board of Selectmen approved a change to the tax abatement program. And those two things, the tax abatement and the pension plan, are really great tools to not only to recruit, but to retain people, because they all have time limits on them. First of all, the abatement has a performance requirement of attendance and participation in fire calls and so forth. And certainly the pension has the years of service requirement that are going to really increase the amount of people that stay in and are committed to the departments. I remember when the program first went in, we had a couple of fellows up north that were going to retire and get out of the department, but when they knew that this program was coming down the pike, they decided to hang in there for 3 or 4 more years so that they could qualify for it. So it is definitely, those two tools are definitely recruitment and retention, you know, wrenches in our toolbox.
Thanks.
Do you have the same participation requirement for pensions as you do for the abatement?
Yes.
Yes.
Yep. They're the qualifying. If you qualify a year of service for the abatement, you would also qualify that year toward your pension credit.
Okay, thank you, John.
John, you said something a minute ago that I'm not sure I understood completely compared to what you said earlier.
Okay.
That somebody who has already retired, and so they would not get the increase from 5 to 10.
Yes, they would. Yeah.
They would.
Yes.
Well,
Yeah, our
okay,
expectation
yeah,
is that this would include everybody in the pool.
yeah. That's what you had said first, but then you were describing the carrot to keep people from retiring. That some people said, "Oh gosh," I'm not blaming you for saying this, but
Yeah.
they're saying, "Gosh, I was getting ready to retire, but I think I'll better, since this might happen, I better hang on." So
Right.
that suggests that, you know, that somebody who is retired would not get the bump.
No, I'm sorry, Fillmore. That was when the plan first started, back in the late 80s, around 90, that there were some people that stayed on because they knew that they were going to then be eligible for a benefit
Oh.
afterwards.
Okay, this
But
was a
I'm not
start.
talking, yeah, that was
All
in
right.
the,
Thank you.
We're going to require they're going to,
Jim, you cut out.
oh, I said, I think what you were saying was it wasn't that they were going to retire, it was that they were going to leave the,
Correct.
Okay. And
prior
just
to the
one,
number of years of eligibility.
just one other comment that, in effect, this becomes an inflation based pension increase. The town pension does not have that inflation.
Right. But the police do.
The police do.
Yes.
Let me just refocus our discussion. We're here today of not to approve any final plan, but just to provide a recommendation to our elected officials as to whether we as a body think that this is an appropriate kind of an adjustment to make in the plan document. So there are lots of final details that would have to be worked out. And of course, the actuary is going to have to price this out before elected officials are going to be in a position to vote on it. So what today we're looking for is just kind of your general sense of whether you feel comfortable with this and whether elected officials should take this up as a as a matter for further consideration.
Well,
I think what-
I'm comfortable with it from just kind of an equity point of view. I don't know what the exact number should be. I mean, you've got 27 people who are drawing now, so that's going to be $27,000 first year, I guess. But no, I think we need to we could point out, Al, as part of our recommendation too, that because of the investment returns and the wonderful work of this committee, I mean, we've got some leeway there. You know, we've got some. You know, the town contribution has, as John pointed out, has been down these last couple of years, and we've got some leeway to bring it back up.
Mm-hmm. Joe?
I agree with the general concept that John has put forward and Bill, but you know, as far as you said, we don't know all the specifics and the cost of the town. Right. So here again, the Board of Finance would have to, you know, probably say something in this as well. But I think John is right, spot on, that we owe, you know, more to them than they're getting today. The question is really who's going to determine that much is up to actuarial numbers and finance position of the town. But I think we could go forward with, you know, starting out, I think it was an annuity or a life insurance policy they had with New York Life or Money or somebody like
Right.
that. And then it transitioned into this, where it is today. But I definitely think, you know, the service to the town is well appreciated, and we deserve to pay them a little more than the $5,000. Something. let's put it that way. I don't know what the finances of the town are, but definitely it's time to move on to something more realistic.
Yeah, I think the Board of Finance would generally look favorable on some sort of reconciliation here. Yeah.
Then what I'd like to propose is,
Al?
sorry, go ahead, Jim.
Yeah, I just want to say I agree with Joe and John. I think we do need, and Paul, I think we do need to absolutely do something.
Okay. I'm going to suggest language, a very general language for a motion, and see if we can all get behind it. I think we need to recommend initially to the Board of Selectmen that it is appropriate to re-examine the benefits structure of this plan at this point in time, that it is timely to do so. Is that something you think we could all get behind?
Yeah.
Anybody think that's the wrong kind of language?
Maybe even a little stronger.
Yeah, I think the re-examining might say we have to lower it. So I think we need to be a little bit more.
Oh, okay. Jim, you want to take a crack at some language?
No, I like what you did. Except it just say, you know, that we look at the structure, but we recommend that the payout be increased.
Okay. Anybody like to second that?
I'll second it.
Okay, thank you. Would anybody like to discuss this any further? If not, let's vote on this. The vote is to, in effect, be recommending that this benefit be re-examined for enhancement, I think, something like that. Could I just see a show of hands if you're in agreement with that? Okay, thank you. I think everybody's on board. I don't see anybody against it. No. Okay, let's conclude on that note. This will be forwarded to the selectmen then to take up. And I can tell you, I think the selectmen will also be very receptive towards this. At this point, I think we're going to get ready to adjourn the meeting. It's approaching 10 o'clock, and I thank you for your patience this morning and for dealing with a wide range of issues. We will be back in touch with you regarding the disability pension hearing as to whether the date we've set aside is the right date. I think there's no point in holding this hearing until we have all of the information. I don't want to waste anybody's time. So keep your eyes open for what looks like it'll be a rescheduling of that date. Anybody else have any final business or thoughts for us? If not, let's have a motion to adjourn. All in favor of adjourning, just raise your hand if you would. Thank you. I think I'm waving goodbye at the same time. Thank you so much this morning. We are
Andrew
adjourned.
Milford.
Thank you.
Thank you, Al.
Bye-bye now.